Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that could be a bit confusing, misleading, and take us off course and help to make it actionable, understandable, and clear. What another week. What another great show. We have some excellent data from the X.com platform that I've curated for you, the listener, so you don't have to spend hours scrolling. I've done it for you. I'm giving you the best. And then two excellent Wall Street Journal articles that I think wrap nicely into the current investing environment we find ourselves in, which is actually not so different than the environment we found ourselves in the previous decade, the decade before that, the decade before that, yada, yada, yada. But I want to start, with some of these interesting data points from the X.com platform. Have you noticed, listener, there's been a little more talk about the price of gold? Have you heard this? So in the news, as the tariff noise has kicked in and the dollar has been devaluing and there's been concern over government and institutions, gold prices have gone up. So I see a chart, and sometimes you could call this a chart crime. I don't think it was intended to be that, but did you know, listener, that over the last 20 years, and I double-checked this, over the last 20 years, gold has outperformed the S&P 500? I was shocked. So I see this is Charlie Bilelo. He shows that gold is up 622% over the last 20 years, while the S&P 500 is up 571%. I looked at that and said, how could that be? I never would have even guessed. I would have gotten that wrong had you put that question to me on who had been the best performer. Well, I say it could be a chart crime because so much depends on your start date for these performance figures. So I went back and I looked and I thought, it's right. Gold has, the data is correct. Gold has performed the last 20 years. The real danger I see, and buckle up for pitch decks coming your way or advertisements, or usually it's like the 10 a.m. television show, so don't watch television at 10 a.m., where someone comes on and says, are you scared about your IRA going to nothing, invest in gold? And it shows an actor who's in his late 70s who's trusted pitching this stuff. I want you to think about the really big charts. So this 20-year chart, admittedly, it's correct. You would have done better with gold. These blips can be found anywhere. Did you know, listener, that $1 invested in gold in 1801, you know what it's worth in 2021? So about 200 years later, $4. You know what $1 invested in stocks in 1801 was worth? $2.3 million. I'll say it again. $1 in stocks in 1801 goes to $2.3 million. $1 in gold in 1801 goes to $4. Now, how could that be if there are these periods of outperformance? Well, it happens. What I would tell you is don't rotate your investment thesis around these short-term performances. It can be tempting to do so, and usually you're just going to invest at the top. Beware. I also love this data point from Mr. Peter Maluk, one of our favorites, Creative Planning. He breaks down the top 10 companies in the S&P 500 by their size, market cap, by various decades. And it is incredibly humbling to realize how difficult it is to predict these things and how the pace of change. I'm going to read these for 1990. Many of you listeners were alive in 1990 and were in your heyday. Not that you're not there yet, but you remember these days. Number 1 in 1990, Exxon. 2, General Electric. 3, IBM. 4, AT&T. 5, Philip Morris. 6, Merck. 7, Bristol Myers. 7, DuPont. 9, Amoco. 10, Bell South. Did you hear that? Not a single one of those is top 10 today. Not a single one. And oh, by the way, tons of change happens decade over decade. So if you go from 1990 to 2000, which ones made it? Well, General Electric made it over in 2000. Actually kept the number 2 slot. Who else made it? IBM. Went down to the 8th slot. Anyone else? Bueller. Well, ExxonMobil hung in there, believe it or else. They went from the number 1 spot to the number 5 spot. That's 3 companies that made it. 3. But you go back to 1970, and we see a lot of names. Eastman Kodak, Sears Roebuck, Xerox, Gulf Oil, 1960. The lesson here is how difficult it is to pick winners. And we can convince ourselves. We go today, top 10, Apple, Microsoft, NVIDIA, Alphabet, Amazon, Meta, Berkshire Hathaway, Broadcom, Tesla, and Eli Lilly. Did we have a shot at picking those even 10 years ago? 15 years ago? No way. 15 years ago, it looked totally different. In 2010, it was JP Morgan, IBM, AT&T, GE, Procter & Gamble, Johnson & Johnson. Apple was on there. Walmart, Microsoft was on there. So only 2 of those companies made it through. Things change, is what Mr. Malouk's saying, and I couldn't agree more. And this, to me, just emphasizes further the need for diversification and to take our hands off the steering wheel. Because if you pick the wrong horse, and people do, and we're no better than others because we're people. If you pick the wrong horse, you could see 30 years of investing go up in smoke. A reminder. I'm going to list off all the challenges that investors have faced over the decades, and effectively to remind you that this tariff storm shall pass. 1930s, Great Depression, 1940s, World War II, 1960s and 70s, Vietnam, 70s and 80s, hyperinflation, commodities crisis in 70s and 80s. 1980s was the real estate and banking collapse. 1980s emerging market crisis. 87 was the stock market crash. 90s was the Asian contagion crisis. 2000 tech bubble burst. 2001, 9/11 and Afghanistan and Iraq wars. 08 was 08, global financial crisis. 2020s we had coronavirus pandemic and high inflation. And here you find yourself with tariffs. Do you want to get off the ride yet? Are you having fun yet? The returns over that period have been 9.8% annualized for the S&P 500. And then Mr. Malouk gave one of our data points. He must be a listener to the show. I doubt it, but he could be. He said, this is as of April 18th, 2025 returns. International stocks are up 6.5%. U.S. stocks are down 10%. That's about a 16.5% divergence. Whoa. So if you're in all U.S. stocks, it's okay. You're okay, but you may have to hang in here for a decade of underperformance and just tough it out. What I don't want you to do is start chasing performance. It doesn't work. Hang in there. Hang in there, investor. But if you were appropriately allocated to international, pat yourself on the back. Recognize that you are right today and you could be known as a fool tomorrow. Diversification is to keep you in line. It's not to outperform it, so that you don't hop around and try to chase asset classes you think will win. I liked this Jason Zweig article, headlined as Wall Street Journal, don't buy into this easy fix for stock market craziness. So of course I'm going to love it. He says, be wary of alternative funds that cost too much, disclose too little, and are higher risk than they sound. Hey, that's almost the alternative of our keep costs low, investing simple, and time horizon long. That he's saying these alternatives are the inverse, which I agree. So listen to this. The Wall Street Journal reported, according to Mr. Zweig, that Blackstone, the big private markets giant, they're partnering with Vanguard. This is, what would Jack Bogle say if he were here today? This is as if Luke Skywalker actually did seek to rule the galaxy with his father, Darth Vader. Darth being Blackstone, Luke and the Rebel Alliance being Vanguard Group. That is what is effectively happening here. So we've got to advocate for ourselves. We can't just say, Vanguard, tell them what to do, because increasingly they may not be telling us the right thing to do. So what's happened here? Also this month, Charles Schwab and Goldman Sachs announced separate initiatives to make more alternative funds available for wealthy individual investors. So what Mr. Zweig sees happening, and what I see is Vanguard, who has a new CEO, Schwab, and others have these huge platforms that were built on trust and low cost. So they brought in droves of investors and bushels of capital, because capital goes to trustworthy places. And Vanguard has historically been that, and Schwab has been that, and Fidelity's been that. Now, of course, I think Vanguard's been the most trustworthy of places, but the other two are just fine. What's happening? Well, they want to push these alternatives, hedge funds, venture capital, private equity, non-traded real estate, private credit, infrastructure, and other assets, supposedly in the hope that lower risk, higher income, diversification, as they'll call it, that were otherwise inaccessible. right? So historically, these private funds have been the domain of the high net worth individual or institution. And the common man has been left with the low-cost index fund or stock. So here you go. The velvet rope is being let down for you to enter, should you? Well, Mr. Zwig says no. He says, if anything, you're late to the party. A lot of these private equity firms are sitting on, this is amazing, 29,000 companies valued at $3.6 trillion that they can't unload. So the industry buys companies, 5 or 7 years later, they seek to sell them, and various vintages of their funds. They'll have like fund 1, 2, 3, and 4, and right now it's tough to sell them. So Mr. Zwig is purporting that, hey, if we can get these retail investors, these Vanguard, Schwab folks to buy in, it'll help us unload. Possible. I don't know that that's true, but it could be. What Zwig hits on that I think is just excellent, why I love Zwig, his articles are wonderful. He takes the bull by the horns right here, because every single slide deck I've ever seen on a private deal shows excellent returns. I've never seen one that doesn't show it. So we don't have the Spiva report for this stuff. So the Spiva report is that excellent report put out by Standard & Poor's that shows the difference between actively managed funds and index funds, and shows the outperformance of index funds over 10, 5, 20-year periods in various asset classes. It's wonderful because the data is not clear for these private funds. There aren't the same obligations to disclose returns that you have with the SEC requires with these other active funds. So what does Zwig go to? He does the exact right thing. He goes to the endowment fund returns. These endowment funds are required, if they're part of these groups, to disclose their returns. So the NACUBO, Common Fund Study of Endowments, has data. Over the 10 years through June 30th, 2024, the median endowment earned a 6.7% annualized total return, net of fees. Okay. That's according to this group. Now, that was, of course, behind the 12.8% annualized total return of the S&P 500, which is not a totally fair comparison. Perhaps, the 60-40 stock bond grew at 5.9%, which was a little less than the private, the endowment returns. But team. All the headache, all the heartache, all the complications, the increased risk you take just to eke out a slight overperformance over a 60-40 stock bond index and a gross underperformance to the S&P 500, it's not a ringing endorsement for these assets. So I'm with Mr. Zwig. I like keeping it simple. I think these private funds are excellent at marketing. They tell wonderful stories. It tickles the ears. You can, no volatility, basically, which is just they don't have that mark-to-market pricing every day like the stock market. They may tell you once a quarter what it's worth. It's the illusion of a lack of volatility. There's plenty of volatility. You're just not getting the price quote every day on these private funds. Zwig does a great job of explaining that. He uses an analogy of weight gain. He says there's one friend that weighs himself every day. Another friend weighs himself once every 12 weeks. Both are gaining weight. The one that weighs themselves every day says, oh dear, I'm gaining weight every day. Something's wrong with my health. The friend that doesn't weigh themselves every day, but once every 12 weeks says, I'm fine. I haven't gained weight. He tells you the weight from 3 months ago. That's the dynamic that can happen in private funds. They can give you a much smoother ride, but it's a bit of an illusion. It's plenty bumpy. You could be gaining weight. Be willing to be simple. There's something elegant about it. And ultimately, I think the data proves out that it's the best thing for you. And in closing, we will briefly touch on a Wall Street Journal article by Hannah Aaron Lang and Crystal Herr talking about the volatility. So with this COVID business and with these, and that was, when COVID was going on so many years ago, you remember that incredible volatility of people making these wild bets starting to come back with tariffs. The markets are moving in big ways based on that uncertainty, and folks are trying to play the game. So headline is, I could lose it all tomorrow. The traders leaning into wild markets. So these wild markets, you've probably seen it or felt it. Boy, the ups and downs. The This article reads, the market is experiencing one of its most volatile stretches in years as stocks swing wildly, sinking 5% one day, surging 10% the next. Even Wall Street veterans found themselves flummoxed. So there's a small group of young traders, it says, going on offense. Instead of returning to safety, they're making bigger, riskier bets, snapping up these short-term options, piling into risky investments. In each one of these cases, they were men. I think that was interesting. And they were late 30s, early 40s. Looking for a little juice, looking for a little excitement. Some of them know themselves well. Like this gentleman, Elliott, calls himself a degenerate gambler. It's made for a good trade environment, he says. Whenever articles like this come out, or whenever you see big volatility, I go back to something I learned from Mr. John Bogle that was incredibly instructive. When you sell a security, when you buy a security, there's someone on the other side of that trade. I find that I can forget that, and most folks can forget that. So whenever you see, great volatility, we think of the market as this amorphous blob, just kind of moving in absentia in this laboratory. No, these are sellers and buyers connecting on price. And if you participate, there's someone on the other side of that trade. So for all these folks doing these short-term moves, there's someone on the other side. So net of fees, the returns will effectively be the market and taxes. It's not a great game to play. And the Bogle, another great thing he said, this was on a CNBC article he did interview on TV when he was living. The CNBC anchor said, I'll never forget this. He said, now, Mr. Bogle, there's all this cash on the sidelines. All this cash on the sidelines. What do you think's going to happen when it finally gets put to work? And Bogle just chuckles and he says, well, once it gets put to work, how much cash is on the sidelines? The same amount. For every buyer, there's a seller. For every seller, there's a buyer. So if you have $100 million on the sideline, here it comes. It's coming in. Guess what happens? $100 million is on the sideline still. You purchase securities. What are you paying? Cash. What do the sellers get? Cash. The cash is still there. Same amount of cash. So do not be seduced by the volatility that there's some way. There are these. Now, I recognize there are experts that can do this. I'm not one of them. They do exist. They are profitable over long periods of time, but even they will lose on 45% of their trades, win on 55%, leverage their ideas. That's not you. That's not me. Push through the volatility. Don't play the games these guys are playing. And ultimately, the scriptures say it. Wealth gained hastily will dwindle, but he who gathers little by little will prosper. So even if you hit it big on one of these things, it's one of the worst things you can do. One of the worst things someone can do is have one of these speculative manias, make a ton of money. They will never, that buzz, if you will stay with them, and it'll be so hard to try to convince them to take the long, tedious road of keeping our cost low, our investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey. Until next week.